Hey everyone, and welcome to another video on the Joan Wick channel. And today we're going to go over external and internal range liquidity. So what does liquidity mean exactly? So liquidity is defined as a cluster or collection of buy and sell orders resting at a key level. Now for traders, there are areas of interest where they act as magnets for price. And what does that mean exactly? So when price moves in this zigzag pattern as you see here, it is drawing towards liquidity in one direction before moving towards liquidity in another direction. And you can see this is a bullish example. Same for a bearish example. Now we get two types of liquidity. We get liquidity resting at the internal range. In other words, internal range liquidity. That's liquidity resting here within this range as we are making this swing. And in the opposite example, we have external range liquidity, and that simply means liquidity resting at the external range. As you can see here, we go internally, externally, internally, and then externally again. So what is price doing when it's moving in these two ways? So when we move internally, we are rebalancing imbalances in the internal range, and we move towards external range liquidity, we are drawing towards old swing highs and lows. So that's basically the difference between these two. And this is a list of the external range liquidity and internal range liquidity that we get. As you can see, externally we have our swing highs and lows, session highs and lows, our previous day, week, daily and weekly highs and lows, monthly highs and lows, equal highs and lows. As you can see, the trend here is basically highs and lows. And internal range liquidity, these are your fair value gaps, your order blocks, your breaker blocks, rejection blocks, and so on. Yeah, you can see our bullish and bearish example. And let's see how this looks like on the chart. So if we have a look on NASDAQ here, let's remove some of these lines. Let's put off this indicator. And I think this will look familiar to some of you. This example here we used in our breaker structure and market structure shift example. But we essentially do the same thing, same as the diagram shown. If you see, we're bullish, we're moving internally to externally. This will be your external. Let's give that a label there. External range liquidity. Let's make it this color blue. Oh, let's turn this. There we go. Got external. And where price go, moved internally. You might not see it there, but if we move down to smaller time frames, there should be internal range liquidity over there. Actually, in fact, if we move back here, it might be that. Does that line up there? Close. But we'll learn about the different types in later videos. But this would be your internal range liquidity. Let's make that blue. Price is moving internally, externally, makes an external swing high. Over here, moves internally to this liquidity here. Now, if you're already ahead, you can see that this is a, here we go. This is a fair value gap, and that falls under our internal range liquidity. This gap right here. Excuse me, my selection is horrible. Moves externally to internally, and then what happened? This candle right here took out this external high, and then what? We moved internally. But simple example of price moving up, down, in this zigzag pattern, as you can see. But basically this lesson is to teach you that there is a motivation to price. Price isn't just moving all willy-nilly. It might seem like that sometimes, but it's always reaching towards some sort of liquidity. Now, the reason why we identify the difference comes later in another video where we'll go into buy side, sell side liquidity. We go into the different types of internal range liquidity, like those gaps that you see here. But for now, this is just to identify that we have different types of liquidity. Here's another gap. You could say that's probably this order block that price is reaching. Oh, no, it doesn't. My bad. But you get the point. We're moving internally, externally, internally, and you can find these on all time frames. This is the 4 hour. You'll see the same type of price action happens on the lower time frames. There is a word for that, I believe. This is when price is fractal. And what does that mean? Whatever we find on the higher time frames, we'll find on the lower time frames. You'll see the same thing. Price is moving internally to grab some liquidity before moving up, taking out external liquidity, going down again, internally, externally. Now, you don't have to go internally to internal in that exact order. Sometimes price will go internally to internal, and that would be when price is ranging. In other words, it's not moving in a particular direction or just moving sideways. Sometimes just external to external to external. But the point is that price is always driven by the motivation of hunting down liquidity. This is why when people make the joke that if they're asking where's price heading towards, oh, they're heading towards liquidity, and they make a joke that you are the liquidity, essentially meaning that price is about to take you out if your entry is resting at a point of liquidity. And if price had to stop you out, that is essentially a stop hunt, and you're being liquidated. You are the liquidity that price is trying to take you out. But that's the end of the video, guys. I just wanted to give the difference between those two. Don't worry, we will get into depth with each type. I'll be going over the swing highs and swing lows, the session highs, the fair value gaps, all the blocks, all of that in the next couple videos. So I will see you then.